Now let's get to Sloan, which is going to lead us into Octavio. Sloan says, I love the scanning tool so far. Now, do you have advice for closing spreads on the last day that are very close to break even? I have found that I have closed a few spreads in the morning to be safe and take a loss only to see that by the end of the day, the trade would have been positive. It's frustrating to take a spread through several weeks all the way to the final day and have a plus or minus 1 or 2 points on the, oh, sorry, folks. There we go. I just popped up out of nowhere. Plus or minus 1 or 2 points on the final day to make or break the trade. Excellent, excellent question. Where are my terrible stocks today? AEM wasn't as bad, but man, that thing has been all over the place. Let's take Costco. I saw this, I think, down as far as much as $7 today, or was it Clorox? Let me take a look here at the research tool. High and low today, range today, 335 to 343. Yep, it's down to 335. Okay, so that did happen at one point, but let's put it this way. Let's go to our custom spread tool. Sorry, I'm trying to be better about not humming when I'm thinking about a price to put into the positions. This is a 5-point spread. Good. All right, so here's a standard bull put credit spread on this position. This is probably a little bit more extreme. I probably should have used the 340 Sloan, but you get the idea. So we're at a 342.5 put today with 337.5 put, 5-point spread, 60-cent net credit, looking at a potential 13.6% return. Probably would have opened this 14 days ago on September 11th, I believe. Yeah, we saw the September 4th using the 2-week bull put weekly spread search. The 100% success rate from the 4th to the 18th. Well, this one would have been from the 11th to the 25th. Okay, assuming, of course, that this was an 80%, 85% probability or higher on the day that we opened the trade. Now, here we are at the last day, and we've seen movements everywhere. We probably would have gotten out of this position, Sloan, potentially. Yeah, we would have. Not the best example, but let's just go to a 3 or 4. I'll go to a 2-day chart. Let's go hourly, I guess. Okay. So let me draw my strike. Not quite right, but roughly that's where our strike is, okay? So we were looking pretty good yesterday, maybe at the close or just before the close of yesterday, when it's only at 347, 346, we would have closed. Sloan, I don't know, but your position specifically, but I might have been able to close the position before the close of Thursday for maybe 30% of what I expected to make, maybe 30% of that 13.6% with 1 day to go. It sucks, but that's how these go. Plus also my 1% rule. This is within my 1% rule, even at the close of yesterday. What do I mean? If I'm holding the 342.50 strike as my sold put, in a bull put credit spread, Sloan, one of my triggers is the 1% rule, meaning if the stock reaches within 1% of that short put strike price, or roughly 350, which would put me at about 346, then I'm going to consider rolling, adjusting, or closing this position because I don't want what could happen to happen. And sometimes this can happen on a bad Friday, and it does happen to the best of us. So what I'm saying here is Thursday on the 2-day chart, when it was here, actually when it was probably here, I would have looked to close, rolled, or adjusted this position. Now, I might not have been at a profit here. You're absolutely right. Still at a day to go, but it's still out of the money, but it is within 1%. It's the buyback cost. We're going to take a look at that. But it's making a lot of assumptions. Take a look at that. Well, we'll look at it at the close. I can only look at it at the close. But in any case, now what happens? When it gaps down here, here's the concept, Slim. You might not like this answer. Sam might not like this answer. I would rather you see this close. Excuse me. Oh, okay. Sorry. William says cost earnings yesterday after the market, hence the volatility today. Okay, gotcha. That's a good point. and I apologize for that. But yeah, so that's probably why this happened. But let's just take that this happened to a regular stock. That's not too far of a drop. It's only a 6-7 point drop on a $300 stock. It's not bad at all. In any case, here's why I said that Sam might not like this comment. I would rather see you close the position here and take a 20% loss of what you expected to make, 20% of the max loss, maybe 30% of the max loss. You're still under that 50%. Rather than be forced to close it here at maybe a 60% loss, or if it continued down in the last day, to take a 100% loss. Even though it ended up back being profitable just barely by 8 cents in my example, I would prefer to stick to my trading plan that when the triggers are hit, MACD goes negative below the SMA 20, which is why I was saying I probably would have closed it over here in that case. But I'd rather you see you take a percentage of the max loss on the last day, even though it ended up slightly profitable, than take, because think about it here, if it just ended at 340, your max loss still would have been 250 or 280 trying to scramble to buy back this 340, 250 put towards the end of the day. That's still 50 to 60%. If you could have gotten out at this moment with only a 20 to 30% of the max loss you expected to take, that 5-point strike difference minus the 60-cent net credit, that's going to be better, and that's going to stay within my trading plan. As William pointed out, I wouldn't have been in this trade simply because I never trade a bull put spread that has earnings coming up between now and expiration. But I'd rather see you do that than risk taking a deeper loss on the position. Or if the market turns on that day, maybe you could buy a second put on the position, which would create a ratio put spread in a sense where you might start to see more profit as the market continues to fall. But now we run the risk that it came back up. I could lose on that put, although my bull put would be successful, but it would no longer be at a credit. It would have been at a negative value, would have been at a debit. So other investors have asked me on the very last day the stock moved against me. It was sort of profitable here at about 10 or 15%. And then all of a sudden the market came down here, and at the opening I was down 90%. In other words, in the first hour, the 11 o'clock hour, I was at a loss of 90% of the max difference in strike prices because it just blew through both and it's trading here at this sudden gap down in the morning. At that point, there's not much you can do. You can close out and take the 90% loss. You can hold on for the rest of the day and see if that only becomes a 40 or 50% loss. What's the biggest risk that happens? That the 90% loss you have now goes to the full loss of 100%. But if it's between the strikes, make sure you close that short put before expiration, because you don't want to end up being put the stock in this case with the bull put credit spread Sloan. But in those situations, why not just wait to the end of the day to see what happens? Because you're already taking 90% loss. Another 10% won't matter too much to your trading plan, because unfortunately the unexpected push you beyond what you would use for your trading plan in that position. Now, a lot of this is discussed not really as a focus to the last day, but following these different rules can be found in that webinar. We referenced it last week. There's a couple of good webinars on YouTube right now that covered this. But in the options strategy section, you scroll down here and you've got the 8 ways to manage a bull put credit spread. So whether I'm on that last day, whether I'm on the first day, if the first 15 minutes of this is talking about the trigger point, Sloan, of when I would look to close or adjust the position. When my technical and fundamental indicators go against me, the stock hits the 1% rule or other things, that's when I need to consider it. And that's the same approach I would use on that scenario as well. Okay, to close the position also. Sam says that he would close the entire spread as well. It's a good idea to close the position, because what if the stock does not go up in this case? Sam's absolutely right. But in the case, Sam, that I'm already at a 90 or 95% loss for a sudden open, might just leave it holding it open to see if I can get a little bit less of a loss on that last day, because I'm already pretty much close to 100% loss. And do not lose more than 50% of your spread if possible. That's where I'm going with too. That's why I probably would have closed it the day before, because it did hit my 1% rule and I would have closed if I was there. William does mention a comment that I sort of touched upon as well, And what is also the risk here? The stock was at that 11 o'clock hour. At one point, the stock was below both of my strike prices. I'm at 342.50, and I bought the 337.5. Okay. And so Williams says, of course, what about the risk of being put the stock? And that's why I said, like, as it's moving back up, if I can get out for that now 50 or 40% loss rather than the 90% loss, I'm going to take it. But in this jump down here, William, when it's below my lower strike price, it did go below my lower strike price. If I'm put the stock here, that's okay, because my broker would have exercised the long to deliver the short. But you're absolutely right. Now that we start going back up here, I've got to consider doing that. But if I see that the stock was put to me at 342.50 and my broker saying, hey, you didn't have as much money as you thought you had to cover the 10 contracts here at 342.50, we can't exercise a 337.50 because you're sitting here at 340, 339. And yeah, I'm just going to sell to close it at market price. Hopefully I can get rid of that right away with my broker and be done with it. It is the risk there. But in this scenario, when it's below both, I'm not worried about getting a sign because my broker would exercise the long right away to cover the short. I'm at 100% loss now. Don't want it, but it shocked me. It surprised me and did what I wanted to. All right. So I thought that was a question more related to the search. It really wasn't in that scenario. It was, but it wasn't. But now let's go back to Octavio's question in this case. There we go. And Octavio says, regarding the PowerOptions search tool, the custom screen. No, Octavio, maybe you mean the custom spread tool. You said custom screen. You said, how can I save my transaction entries for later retrieval or review? Okay. So I think you're talking about the custom. We're going to look at two things here. If you're talking about the custom spread where I just build a position on the fly. So I'm going to take AEM and, oh, yeah, that's right. I thought this had weeklies. It doesn't. And I'm thinking that AEM is going to be a bullish position, but I'm worried that there might be extensive downside to this position if something falls out. So what I want to do is this. Nope. No, I don't. Yeah, I do. No, I don't. I apologize. Okay, well, anyway, let me just do it this way. So I'm going to buy 275s. No, I'm not. I'm going to sell. I'm sorry, guys. I'm going to sell a 75 and buy 280s. All right. So I'm going to do sort of a back spread. And this is the opposite of what I said. So I'm really bullish on the stock. I think it's going to move up. But if it really tanks and I'm really worried, I want to create sort of a hedge where I still receive a small credit or have a very low net debit on the position. Okay. So Octavio, if you're talking about the custom spread tool, how can you save the settings here? The only thing you can't. This doesn't save settings like this. Okay. What I would do is just add it to the portfolio. Okay, so here's my position that I structured. I want to evaluate this. I'm going to create a separate portfolio, Octavio. So let me go to add to portfolio, and I'm going to call it custom positions analyze. Okay, now it's going to start me off with that $100,000 cost basis, and let's increase this to 20 to 10. Whoa, no, you don't. All right, autofill there. Doesn't matter. Okay, so we're just going to do 20 and 10. I'm going to do a ratio back spread, and I'm going to put it into here. I'm not going to review this I'm sorry. I'm not going to go into this portfolio and track and manage it. I'm not going to evaluate lots of roles. But that starting point from where I just came from, these numbers that I was using at X time of day, I can now go back in 3 days from now and says, what was that position I was thinking on AM? Okay, there it is. Let me now go back to my profit and loss chart. This is what it was on September 25th. Okay, so at least I know where it is now. Now I can evaluate where my positions are. That's really it. There's no settings you can really save in this case. You just want to track it in a separate paper trading portfolio, I feel. Go along with it in that way. Okay. The follow-up there. I'm sorry, I jumped ship, but we'll include this Octavio's question in this as well. But that's how I would do it. I would just save it in the portfolio, in a spare portfolio, a paper trading portfolio, Octavio, and then go back to it later when I wanted to view how is this position doing, or, oh, the great thing about that portfolio too, excuse me, is you can always put in the notes there. And you can put in thinking of a weird back spread, feeling AEM is recovering, wants upside repair. Oops, sorry, folks. Want upside repair, but worried about downside. Okay, and since I bought 2 and sold 1, I don't have any extra margin on this position. I go back on Tuesday, Wednesday, or hey, next Friday, we're going to check this position, Octavio. We're going to see where it stands. We're going to be able to go back and see exactly what it was when I had looked at it this afternoon at 5:57 p.m. Eastern Time. And on that note, what I want to do is go back to Costco, and I want to go to the option chain. So remember, for Sloan, of course. And Sloan says, thank you. These Friday seminars are a big help. Sloan, I'm very thankful that you like these presentations, and thank you for your question. It's a great question. William brought out a great point about some of the risks of not closing that position because you may get assigned early during those last few hours of the trading day if you're shorts in the money and you're long is not. And Sam brings up a point. That's always mine. I try to close it if I have a 50% loss and my triggers are hit. But if you miss it, like I had on February 5th of 2018, when that initial volatility spike occurred because of the Chinese tariff threats and everything, the positions I had expiring on the 9th, on the 4th, they were profitable. The Friday before, they were profitable. And then that morning, February 5th, within 20 minutes, they were at a 50% loss, and I closed all 3 of them. 3 days later, they were all at 100% loss in the positions. They never went lower than a 50% loss after that first move. I was very, very happy I got out of those positions. But I just wanted to see real quick, going to our Costco position, remember we had sold the 342.5 put, bought the 337.5, a 5-point spread, and we took in a credit of 60 cents. So my true maximum loss would have been $4.40, right? That's the most I could lose on the position if I took the full 5-point loss, because I keep the 60 cents regardless of what happens. 342.50 put for the 25th, 337.5. Would have cost me, this is at the close when it came back up, so I don't know where it was at the bottom, but at 458 to buy to close the short, 245 sell to close the long. So this would have been a loss at that point of $2.13, which is not quite 50% of the 440 maximum loss. But I guarantee you sometime yesterday during the trading day, I would have closed it for the 50% loss rather than seeing it at the open, probably being at an 80 or 90% loss and then hoping to hold on as we were talking about to where it could have been profitable. I would have closed it the day before. Actually, looking at the chart of Costco, I probably would have closed it a few days before. But again, this was a fake trade, right? This 342.50, I don't think ever had, well, maybe a day later, but a day to go to expiration. But a week out or 2 weeks out ago when Costco was still coming down and then starting to come back up, that 342.5 put probably didn't have the 85% probability I would have looked for. But yeah, I can see here that I would have closed this position probably the day before or even on Wednesday, perhaps, when it hit that 50% loss. Now, yes, would it have ended up profitable by 8 cents and been at full profit? Yes, but that's the nature of the spreads in these equations. The other fault here, as William mentioned, we never would have traded this because it had earnings last night after the close. So we never trade a credit spread through earnings. Right? You look for the ones that don't have earnings between now and expiration. All right. So that's where I was going with that as well. Okay. So, I mean, that was just for you where I would refer to Sloan. Would I have missed out on a profitable trade? Yeah, but I would have been biting my fingernails to the last 4 minutes. We had a discussion a couple of weeks ago about a gentleman who brought up the point that, oh no, it was an email that someone sent to me. I think we brought it up in the topic, Sloan. I apologize. But there was an investor who had a position. Oh, did I get rid of it? I did. I'm sorry. Oh, no, there it is. Who had a position where he was holding it through expiration, and it closed on Friday at 4:30 above. It was a Tesla position. It closed at Friday at 4:30 above the short put strike, and it was expiring that day. But in after hours trading, in the next 20 minutes, the stock fell about 10% and was right here between the strikes. So they got put all the shares of stock on Tesla, and the long couldn't be used to deliver the shorts. I think this example that I read on a blog was even worse than that. I think in the after hours trading, before the options cleared at 4:30, Tesla actually fell below both strike prices. But for some reason, the broker had cleared this out as already being expired, but this was assigned. And it was confusing, but that happened. So there's a risk. Let's just see if it's there. I doubt it did, but let's just see if we can see it here. Sorry about that. Just go to big charts real quick. Oh, that's mean. So, excuse me, I didn't mean to be that loud. At 4:30, we saw it close at 342.58. After hours trading, we don't know what time it would have happened, pre or before clearing, but according to after hours trading 5:47, this is at 342. Our 342.5 put is 50 cents in the money. Our 337.5 put's gone. I'm waking up Monday long 1,000 shares of Costco, 342.50. Eep. Definitely close before the close if you can get a profit. And in this case, don't expect it's just going to expire worthless if it's knocking right there in the door. Good 3, 4, 5% still out of the money is what I look for in a successful trades. Okay. Okay, Sam has just talked about this isn't related to you, Sloan. This isn't related to our topic of conversation here. What Sam was just saying is that trying to buy puts in oil stocks. I bought a 15 strike and 16 strike puts in OXY, Oxy, and 16 strike puts in Halliburton. And they both are nicely down and was both nice trades. I got out of both oil plays today, though I have 1 month time in the positions. Okay, good. There we go. All right, so... William says, Michael, when taking a 14-day trial of PowerOptions, how far back can I go on the market sentiment tool? William, I want to say I don't know. I'm going to say it's 3 months, William, honestly, because I think that's the change we just made when we noticed it. What I had mentioned there that no one, that I hadn't seen yet, I hadn't understood fully what Frank was saying. Yeah, what Frank was saying when he was commenting about how he couldn't use the scrubber and turn it. He wasn't saying that he couldn't use the scrubber. He was saying that how am I seeing 3 years and he's only seeing 10 days? And what is with the green and red marks? And I explained it to him, but he isn't seeing those, and I didn't notice that. So I think we've made the change now that for subscribers to the 20-minute delayed and even the end of day data, that you should see 3 months. And when you click that, when you're looking at the view details and you click view past or view historical, it'll only allow you to go back 3 months. I believe that's the answer, William, but I'll look into that for you as well. Kip, you say another great session. Thank you. Love the new graphics. Have a great weekend. Thank you, Kip. I'm glad you approve of those as well as William did. Now, real quick, I do have to remind you all, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or trading suggestions. As we've seen and discussed throughout our time together, options do involve risk and may not be suitable for all investors. Relation to what William said about the trial, remember, you can take a trial to PowerOptions at any time. Simply go to PowerOp.com. Just enter your name and email address. No credit card or billing information is required. You'll have 14-day access to our patented search tools, which we didn't really take a look at today. Our research and analysis tools, we looked at some of those. The signature tools, we talked about the long option finder. There's a volatility skew tool there, an insurance tool for if you have stock with an unrealized gains. And of course, the portfolio tools for tracking positions and evaluating rollout opportunities. Plus, all the virtual access to all of the virtual library webinars and much, much more. Just need name and email address, and you'll have full use of the site for 14 days. The subscription levels after that start at only $45 per month for the end of day service. The delayed service is $65 per month, about 15-minute delayed data. You can upgrade to the historical service, which will give you the full historical data record that we have going back in time, not only on the market sentiment tool, but for the searches that we looked at, the back testing tools, and more. You can cancel at any time. There's no contract for the subscriptions. Free coaching. The coaching sessions are available on all levels of subscription. You can also upgrade to the next level at any time. And as I mentioned, as a subscriber, you have full access to all the webinar archives. Some of those are not available on the public page, and some of them aren't available to trial members, the most recent 5 and some of the strategies. But as a subscriber, you've got access, of course, to everything. Other free information, well, the archived webinars page I mentioned, you can just go to PowerOp.com. Click on the webinars there. You'll be taken to our webinars page, our archived webinars page. The full link is powerop.com/webinars.asp. You can also take a look at our YouTube channel. Just go to YouTube, look at Power Options. You'll be able to see all of our posted videos there. They're all public. 90% of them are public. 97% of them are public. So you can go through those at any time. Hey, you can see some of the ones we referenced in today's presentation as well. Of course, you can also go to our blog or check out the Learning Center on Power Options for other articles and educational resources. But of course, if you have other questions, send me an email at any time. You can reach me at support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And remember, trial members and subscribers, you can schedule that free coaching session, parentheses S. There's no limit to how many you can have during your trials as a subscriber. At any time. That's essentially a 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site, answer any questions that you have, strategy-wise related to the tools, and more. If, of course, we think that you need more help, you need more of mentoring, well, we can discuss sort of a paid-for coaching or paid-for mentoring, depending on your needs and what we need to evaluate there as well.